What makes a great dividend stock for dividend investing? That's what we're talking about here today, guys. I hope you're doing great. As always, if you're new here, I am Jeremy, and today I want to share with you guys exactly how to judge a stock if it is a great dividend stock to get maximum gains in the future, or if this isn't such a good stock. And there's a lot of things that newer investors in the market get tied into when it comes to dividend stocks, things they are looking at that I'm telling you, some of these things are the wrong things to be looking at, and sometimes you want to be looking at these other things, guys. So I hope you get a ton of value out of today's video. Make sure to smash a thumbs up if you do, and share this with somebody that might be interested in dividend investing. By the way, I get a question a lot on like what are my favorite stock market apps and websites to use on a daily basis, and so I created a PDF that goes into those top 5. So make sure you check out that, guys. I'll probably have it as a pinned comment. I know it'll also be linked in the description. If you want that free PDF, go ahead and check it out, okay? So let's start getting into this. How do you judge a dividend stock for basically becoming a great dividend stock, okay? So the first thing most folks look at when they're thinking about a dividend stock, the first thing they look at is yield. Meaning, what is the dividend yield that stock is giving you? Is it a 2%? Is it a 3%? Is it a 4%? Is it a 5%? And this is how a lot of investors mainly judge a dividend stock when they're getting involved. And this is the most overrated thing when it comes to dividend stocks. Whatever the current yield is for a particular stock out there, whether it's 2%, 3%, 4%, it's the most overrated thing in the world. This is what everybody's looking at, and I'm telling you guys, this is not where the game is. I've seen so many people chase after high yield dividend stocks, those stocks, you know, that have a 6% yield, 7% yield, 8% yield, maybe even a 10% yield plus. And they think, oh my gosh, this stock has paid out so much in dividends in the past, they're going to continue to in the future, and they don't, okay? And a lot of times I've seen it where people are chasing these high yielders and they lose actually way more money on the stock depreciating over time, the stock price depreciating, than what they get in dividends. And they'll hold a stock for several years, they made a bunch of dividend money, but net they actually lost money because the stock went down more than the actual money they got paid out in dividends, okay? This is the most overrated thing you can possibly look at when it comes to dividend stocks, and this is a thing that almost all dividend investors are fascinated by when they look into a dividend stock. And I can promise you it's the biggest mistake you will make, just judging a stock based upon, oh, this stock pays a 3% yield, this one pays a 4% yield, the 4% yield is better for me. Oh, this stock pays a 7% yield, and this one only a 2%, the 7% is better. It doesn't work like that, guys. Because when you own dividend stocks, and especially when you're owning them for several years out, there's so much more that goes into it that can determine whether you get future gains on that stock or losses on that stock, whether you get future dividend raises over time or actually dividend decreases over time, okay? So yield, most overrated thing when it comes to dividend investing, okay? Past track record history. So essentially you can use a website such as Yahoo Finance to go ahead and look at like how much a company paid in dividends in the past. You can look at years and years in the past, okay? And basically look at a company's past track record for paying dividends. This is actually pretty relevant, and I love to kind of look at this if you're looking into a dividend stock. And I think it's important to look for a few things, okay? You want to look for a company that is not only consistently paying dividends each and every quarter, but is raising those dividends each and every year. You want to really look for those companies that have 10 years, 20 years, 30 years, maybe even 40 years in a row, raise their dividends, okay? Now, just because a company has a 20-year track record of raising dividends doesn't mean you're automatically going to get a dividend raise next year. And for a matter of fact, it doesn't even mean the company has to pay dividend in general. But generally speaking, if a company consistently raises their dividend year in and year out, they're probably going to continue to do that as long as their business is doing good, okay? So I think this is a very important thing if you're judging a dividend stock, to look at its past history, and are they consistently raising that dividend? Are they consistently paying out that dividend for years and years and years now, okay? Very important thing to look at. Revenue trend, also another very important thing to look at when you're looking at a dividend stock. Remember we talked about yield, okay? So a lot of stocks can go high yield dividends because their business model might actually be shrinking, meaning their revenues are actually going down. So their revenues are going down, meanwhile their stock price also goes down, and maybe they kept that dividend so their yield looks really high. Well, a revenue trend that's going down, generally not a stock you want to be involved with unless you have some pretty strong certainty that the business model is going to turn and they're going to get back to growth, okay? But a lot of times when these companies start going negative when it comes to revenues, they continue to have their business shrink over time. And many times the management teams cannot recover that business model model, okay? So if you see revenue downtrending, generally speaking, that's not a positive sign from a dividend perspective, because their business is shrinking, their stock price is probably going to shrink, which means their net income is probably going to shrink, okay? Net income trend, another very important thing, even more important than the revenue trend. Net income means their bottom line, like how much money is a company actually making or losing in a given year or a given quarter overall, okay? This is the most important thing to probably look at when it comes to dividend stocks, because you're going to be able to tell, is the company becoming more and more profitable over time or less and less profitable over time? Look at the last 5 years for a company and tell me, like, where's it at and what the trend is there, okay? If a company's consistently having their net income going up and going up, doesn't mean it will absolutely go up in the future, because it could go down, but it means there's a greater likelihood. And on the flip side, if a net income is going down and down and down, it means there's probably a trend there. It's probably continuing to get worse, okay? Net income is so important because that's actually the money that at the end of the day, the companies usually pay out to shareholders in the form of dividends, okay? A portion of that net income is usually what's paid out to these shareholders for dividends, okay? So this is even more important to look at the trend there than actually the revenue trend, okay? So now we're starting to look at some things and we're starting to get some context on what makes a great dividend stock. We really want stocks that have revenues going up, net incomes going up, have track records of consistently paying out dividends and raising those dividends each year, okay? Trailing 12-month PE versus forward PE, also important to look at, not just in determining whether a stock's undervalued or overvalued, but you want to see a company that generally has a higher trailing 12-month PE than their forward PE. Generally, you want to find a company that is supposed to be more profitable in the next 12 months than in the previous 12 months. Those are the type of companies you really want to be involved with. So you want to look at what the trailing 12-month PE is, what the forward PE is. Is the forward PE lower, okay? So an ideal situation for an average industry out there, let's say the trailing 12-month PE on average for the S&P 500 is, let's say, 16, okay? Okay, cool. So let's say the stock has a 16. Ideally, you want that forward PE to be something like a 14 or 13, because that means the company is expected to actually get much more profitable in this upcoming year versus this past year, okay? And if you're thinking about a dividend stock and making dividend money off of a stock, you want a company that's going to be more and more profitable in the future. That's a good thing for you, because that means they'll continue to probably pay out that dividend, and they'll probably continue to raise that dividend each and every year. So very, very important. Balance sheet. Balance sheet is way underrated when it comes to dividends. So many dividend investors don't even bother to look at the balance sheet, okay? This is so important. This is so important. This is a fundamental piece of all judgments on fundamental investing, is the balance sheet. And dividend investors, a lot of them, not all of them, but a lot of dividend investors just disregard the balance sheet. And I can promise you, a balance sheet can get a company into so much trouble. If a company is loaded up on debts, okay, they're loaded up on debts and they don't have a lot of cash and investments around, then you're looking at a company that's probably going to have to make mass interest payments on that debt over time. If a company's making mass interest payments on that debt over time, then how much money do they actually have to pay out to you as a shareholder in the form of dividends? Probably not much, right? The company's debt is continuing to climb, and maybe their interest rates are even just starting to climb, right? They're paying out so much money all to the banks, and then there's what's going to be left over for you at the end of the day. Also, a company with a bad balance sheet is going to get itself into a lot of trouble in a recession scenario and probably have to cut their dividend completely. So that stock you bought that had a 3% dividend yield or 4% dividend yield, in a recession scenario, they might have to cut that completely. So you get no dividend during a recession, because if they don't have much cash around and they're paying out debt, then in order for the businesses to survive, if they even have a positive net income, they're probably going to need to use every dollar of that just to pay off debt, because basically the banks probably won't be loaning them money during a recession time. So they stick themselves in a really bad scenario, okay? So if I'm thinking about the most underrated thing when it comes to dividend investing, it is the balance sheet. Dividend investors love to just take for granted a balance sheet. I can promise you, always look at the balance sheet, because you will get hurt very bad if you're not, okay? The yield, most overrated thing. Balance sheet, most underrated thing when it comes to dividend investing, okay? Next thing up is the management team. Executive management team, very key. If you're buying a company, long-term investing, which generally if you're dividend investing, you have a dividend portfolio, you are generally like a long-term investor, a value investor, or something like that. Value investing, long-term investing, and dividend investing, they go together. So they kind of get warped together, and that's generally what people do, okay? okay? So a management team, if you're investing in this company for the next 5 years and you want to make more and more dividend money each year, very, very important that executive team knows what they're doing, makes the right decisions. So you need to judge that CEO. What's the CEO done since he got to that company? Has he made the right decisions, the wrong decisions? Where's the stock price gone since he's been at that company? Where's the revenue trend gone since he's been at that company? Where's the net income trended since he's been at that company? All those things are very, very important to look at that management team, because a great management team, they're probably going to grow that business over time. They're probably going to protect that business over time, and you're probably going to make a lot more dividend money in future years than you will have even in past years, guys. Management team, also another super underrated thing when it comes to dividend investing, okay? Next thing you want to think about when you're kind of thinking about, is this a great dividend stock or not a great dividend stock, is for the business model. You want to think about the business model. What products and services does this company sell, okay? And what is the opportunity for this business model over future years? Super, super important, okay? If a business model is already maxed out, if they already have pretty much as many customers as they can possibly get for their product or service, or their market is shrinking, things like that, that's bad, okay? That means that's just a bad sign. You want to buy into business models that have huge opportunity in front of themselves, that they can grow market share, or they're going into markets that are like brand new and there's almost like infinity amounts they can grow into those type of business models in the future, okay? You want to look at that business model opportunity. Companies with huge business model opportunities are probably going to provide great returns for investors over future years, especially as long as you're not buying them when they're overvalued, okay? These are the type of companies that not only can you probably get a lot of dividend share gains in the future, but you'll probably also get a lot of share price gains in those type of stocks as well, because they'll probably grow the business massively bigger in the future if they have big opportunities in front of themselves. Think about that business model. What's the opportunity there, okay? Next thing you want to think about is, what is the business model competition? So in the products and services a company sells, what's their competition? Are there any competitors that are coming in their space that are such serious competitors that they could really actually damage that company in a massive, massive way and put that company in a situation where they can't grow their revenues, they can't grow their net income, their business is shrinking, their dividends are shrinking because the competition is too tough? You got to really think about how that business is doing, foresee the competitors in their space, okay? In the annual report, the 10K of all companies, they list out their competitors and why their competitors are a risk factor for the company. Very important to always look at those risk factors in a 10K. By the way, you can go to like investor relations page of any company out there. So let's say you were thinking about investing in, I don't know, Nike, right? You just type in Nike investor relations, go on their website, click on their 10K or annual report, and in that report, they're going to have their competitors listed out there and what the competitive threats are. This is super, super important, because if the company has too much competition or too big of a competitor coming in their space that's going to eat their lunch, then the business model is going to go down. The stock price is going to go down, so you're probably going to lose money in the stock. And guess what else is going to happen? Probably that yield will get cut or not be able to get raised in the future, okay? All very bad things, so think about the business model competition, all right? And last thing you also want to consider is payout ratio. Payout ratio is super, super important for a company, okay? So let's say there's a company that has $1 of EPS, okay? $1 of earnings per share. And let's say they pay out dividends each year of essentially 75 cents, okay? 75 cents they pay out in dividends. This essentially means that this company has a 75% payout ratio, okay? Which once again means that they're paying out 75% of their earnings per share, they're actually money at the end of the pie, out to shareholders, okay? That number is a bit high. Personally, I like to try to find payout ratios under 50%, because this means the company is probably saving away a lot of money, or using some of that money for share buybacks, or using that money to go ahead and buy other companies, or just storing that money on the balance sheet for a rainy day or pay off debt or something like that, okay? So I generally like to find companies that have payout ratios under 50%. That means they have a lot of room to raise that dividend in future years, even if the earnings per share were not to go up, okay? If you have a company with a really low payout ratio, even if the earnings per share were flat, they could still raise raise that dividend for years and years to come in the future because the payout ratio is so low. Companies that pay out over 75% are generally companies that aren't going to raise the dividend much in the future at all, if they even raise it at all in the future, okay? And so I see a lot of times people get attracted by yield and they're like, oh, this stock's awesome, it has a 4% dividend yield. Well, that stock also has a 90% payout ratio and almost no revenue growth or net income growth. And so you look at a business model like that and it's like, okay, it has a 4% yield, but you're probably never going to get any raises in the future. So if you hold that stock for 5-10 years, you're probably still going to be getting that 4% dividend yield, okay? Which might be fine for some people, but meanwhile, maybe there was this other stock over here that had a 3% yield and only had, you know, a 40% payout ratio, and they were able to raise their dividend more and more over future years, and so that 3% yield over time maybe goes to a 5% from where you bought the stock, or maybe a 6% or something like that, and all of a sudden you're blowing that 4% yield away, guys. So if you want to judge a great dividend stock for dividend investing, you want to build out a dividend portfolio or just add some dividend stocks to your portfolio, think about some of these things. I hope this video gave you guys a ton of value. I think I try to give away as much information for free on this video as I could possibly give, guys. So if you really enjoyed it, make sure you smash the thumbs up button. By the way, if you want to know all my favorite stock market apps and websites I use, go ahead and check out that PDF. The link should be in the comments or in the description, all right? Thank you for watching and have a great day.